revisiting the efficient market hypothesis and thinking about what would an AI do today. The efficient market hypothesis came up in the 50s and 60s because we had computers. I'm going to elaborate on that. But a new technology, a new technological innovation enabled people to come up with new theories and evolve into knowledge, explanatory knowledge about how financial markets actually price assets. So I want to talk about this, sort of revisiting basically an old friend. I was fortunate enough to have classes with Eugene Fama, one of the proponents of the efficient market hypothesis, and just want to make sure he's not a friend, he's a professor, and I have all the respect for that. I just meant a little friend more in a sort of metaphorical way. And then I want to talk a little bit about where do we stand today? What kind of innovations do we have today, and what kind of theories? So this is a Not Even Wrong podcast. It's November 29, 2021. Delco for the day, the fund's up 5.25%. The market's up 1.5%. For the year, we're up 43.5%. The market's up 22%. We're outperforming by 21.5%. So I'm in the process of writing my memoirs, and it sounds a little bit more spectacular than it actually is. What I'm really doing is just writing about my life and trying to come up with the interesting stuff, make it an interesting read, inspired by, and the name eludes me right now, the book is called Barbarian Days. Person that works for the New Yorker, he wrote his biography or memoirs. And I thought it was a great book because it was just an interesting book. It's not about the person. It's more about a life in a certain time horizon, in my case, from 1968 until today. And there's a couple of things that I went through in my life that I think are worth mentioning. And it's actually more about those events and the sort of thinking around it than actually my personal life. So this is why I'm also writing about my experience at the University of Chicago, and in particular having lectures with Eugene Fama. So this is where all this comes from. So why am I revisiting the efficient market hypothesis? Because it's, I think, very healthy to go back and think about some of these things, and particularly for practitioners in the hedge fund industry, I think it's incredibly valuable to go and revisit the theory of finance. Some people say that it's not very helpful, and I do agree that the theory of finance that was evolved in the 50s and 60s, and actually maybe even today, whatever is written in the journals is probably not very useful for wealth generation, but it's useful for other things. And you kind of have to always ask yourself the question, what is the question that I'm even asking or trying to answer? And then you will find out that all these academic works, that they're very often very useful and actually much better than their reputation. Unfortunately, the economics and the theory of finance isn't like engineering, where you can come up with stuff and then actually implement it and evolve products and services out of it. But sometimes you can. And Fama is a great example of how that actually works. So let me elaborate on the theory of efficient market hypothesis. And let me just say that actually a couple of people, a couple of ideas, a couple of innovations came out of that were implemented in the real world. Amongst others, let's say David Booth and his fund, the Dimensional Asset Management, I think it's called. He made a lot of money. He actually gave a lot of money to the University of Chicago, and now the business school there is called the Booth School of Business. I would say, the whole index fund revolution started with the efficient market hypothesis, and I would even argue that all the algo traders, so all these perceived geniuses out there that make money with algorithms, they really have their roots in the efficient market hypothesis. Another thing which the efficient market hypothesis sort of helped spring out was the whole event-driven industry, which was big also for me and my partner Zovinar. We kind of started in that business when we were in the hedge fund business, event-driven, because the pricing of events was not very well understood, but the idea and even formulating something that's called an event, that started with the efficient market hypothesis. So the efficient market hypothesis, in my view, and I'm paraphrasing John Cochrane, who is a professor at Chicago, and in his introduction to a lecture that Fama gave in 2008, he says that the efficient market hypothesis is more like the theory of natural selection by Darwin. It's a fundamental thought process. It's a fundamental framework to think about something, and it doesn't maybe directly lead to products and services, but once you start thinking along those lines, a lot of interesting things start happening. And this is kind of where I see the efficient market hypothesis. So now let me talk about the hypothesis. In general, it just says that the value of assets reflects all the available information in the market. So the efficient market hypothesis is by definition or innately also a theory of market equilibrium. And that's the first criticism. Everybody's saying, well, there's no such thing as equilibrium. Economists are crazy. Why do they always talk about equilibrium? This is like saying, well, the theory of natural selection is also a theory of equilibrium in the sense that it says, well, there is a new niche in an ecological environment, and then through mutations, genetic knowledge is created and instantiates a certain species, and that species dominates that certain ecological space. But of course, that's not the end of the story. Once the species evolves, other species evolve around it, then the species might die, new species come, species develop better things. Let's say, birds came up, but then better birds came, eagles, they were stronger than others, other birds were faster. So there's a constant evolution of better traits, better skills, better knowledge to evolve around the nature. And the same way the idea of the efficient market hypothesis, which is, like I said, linked to the theory of an equilibrium, it's a dynamic theory in a sense that it says, look, there is maybe an equilibrium in a certain instance in time, but it doesn't mean that by definition this equilibrium will change and we will evolve and so on and so forth. So what it actually means is that the information that is in the assets reflects the value. So what that means is that if you have new information, you can then also generate value. And it also means that if you have information which is already reflected in the value of the prices, then you will not be able to make money. Now, the little history of the efficient market hypothesis says the following. It says that we have the rise of computers, and then we have the ability to crunch data. And with the ability to crunch data, things evolve, such as, for example, the idea that we could test financial stock prices and the returns and see if there's autocorrelation. So are stock prices related to each other, or are they martingales, which means a sequence of random variables? And the answer is, it looks like there is not a lot of autocorrelation in stock prices. So therefore, people start, this is sort of in the 50s, 60s, start thinking, well, okay, what is this then? If there is no autocorrelation of stock prices, they follow the random walk, the martingale, and such things that I think every student today in Finance 101 learns. What that really means is that we have, in order to make money in the financial markets, we cannot rely on correlations. We cannot rely on the past of the stock prices. We need to find new information. And I think this, to me, is the absolute key of this whole story. That the business of wealth creators in financial markets, i.e. hedge fund managers, is really to find new information that is not reflected in the value of assets. And that information can be found in several ways. Now, this is David Deutsch. Information can be found by developing new theories, because any kind of observation is theory laden. So if I have a new theory, then all of a sudden certain things which might not have been useful, all of a sudden turn into information that can be useful for the valuing of assets. I can also find new information just by literally exploring new information. For example, I can develop better ideas of quantum computing, and have new information of, let's say, what kind of substrate actually works better in terms of developing quantum states and having them in a coherent way so we can actually use it for computation. That is information that is certainly also theory laden, but it's also information, it's more along the lines of, let's say, when Christopher Columbus discovered America, they just had new information about, let's say, the existence of gold and things like that. So new information is the absolute prerequisite for returns in the market. If you don't have new information, you're just you're regurgitating. I don't know what the actual word is. I'm sorry. So anyway, you're using the same old information and you're repurposing it, and that will not evolve. You will not be able to generate return. So this is, I think, one of the biggest lessons that I took from the emerging market hypothesis, which is if I want to make money, I can't rely on things like asset prices. I can't predict the future of a stock price given the old stock prices. I can't do any of that stuff. Now, of course, the algo traders will tell me, well, are you crazy? This is what we're doing, and we're very successful. And I say, yes, of course, because what the algo traders are doing is, and this is one of the biggest, I think, inventions of the efficient market hypothesis, which is the efficient market hypothesis basically said, look, everything we can explain with the existing stock prices, that's information that is in the value, and whatever we can't explain going forward, that's risk. And what the algo traders are doing is they're trying to dissect that risk, because they're saying, look, there is more to that risk than we see, and we can probably sort of peel that risk a bit off like an onion and find information that is useful, find the signal to noise, and therefore make money. And that is absolutely consistent with the efficient market hypothesis. What algo traders are doing is basically dig for more information in, let's say, shorter time spans, or in developing models, which is nothing else but explanatory knowledge about the evolution of financial markets. So because what the efficient market hypothesis said is not that given the stock prices, you can't predict anything in the future. They just said that with all the information available in the market, you can't predict anything. But if you can get new information, and if you can, for example, be more granular in the way stock prices evolve and find maybe certain correlations that on the big scale, let's say when you do just a simple time series, you don't see, well, then you can make money. And this is what the algo traders have been doing. I think it started in the 70s with Victor Niederhofer, who was at Chicago, and then it just evolved into a big industry today. Now, let's talk a little bit about what we're doing actually here at Orange Capital Partners. And this is, to start this conversation, I just want to ask a very provocative question. What would an AI do today? Let's say if I had a super intelligence that looks at financial markets, what would that thing do, that AI? How would they structure themselves to generate wealth, if that's the objective function in fact? And I think there's two things an AI could do. I think the most interesting thing that the AI would do is, I think, try to build some sort of self-supervised reinforcement learning model, where you treat the financial markets like a sort of a game of chess or a game of Go, and you create reward functions, and then you self-play billions and billions of times until you figure out new information or new strategies that aren't available in the current markets to arbitrage or to take advantage and make money. This is one of the things that I think an AI would do. Now, this, to my knowledge, is not being done yet. And if it's being done, please shoot me a note, put it in the comments. I'm more than happy to engage. We at Orange Capital Partners are very, very interested in a self-supervised reinforcement model that tries to become more proficient in generating returns in the market by learning through self-learning. So again, we're not looking for any kind of past pattern-seeking machine learning model, none of that stuff. We're not interested in extrapolating from the past. What we're interested in is finding ways through self-learning to new strategies. Let me give you an example. Maybe that illustrates what we mean. We believe that an AI would be able to kind of work a little bit like the Tesla AI works. What does the Tesla AI do? The Tesla AI, think of it the following way. Before Tesla, we have Google Maps. So Google Maps is a pretty good representation of traffic. We have all the maps of the roads, and then we have traffic patterns, and when it's red, it means there's a lot of traffic and all that. And we can learn a lot from that. We can learn patterns. We can understand that on certain days, Highway 101 is clogged and this and that, and we can even extrapolate, okay, this is how people behave, but it's all kind of on the aggregate. This is, I would say, how the financial markets work. The financial markets are kind of like a Google map for actors in the markets. So they aggregate stuff, and it's not very granular, but you can learn a bunch of things. You can certainly make certain statements about the behavior of people, about the behavior of financial markets, etc. Now enter Tesla. Tesla has the the luxury of going much more granular. Instead of looking at traffic, Tesla is now looking at the single car. And following the driving of the car, Tesla can learn a lot more about driving than just if you look at Google Maps. The equivalent in financial markets would be that we're now looking, if we had an ability to follow every CEO, if we follow with this analogy, we would say that the company is like a car and the CEO is the driver of the company, or the CEO is the driver of the car, whatever you want to use. And if we could follow a la Tesla all the actions of the CEO and see what she does and how she acts, we could then learn a lot more about how it is to drive a car and probably evolve an AI out of that. I think this is one of the approaches that will be incredibly interesting. What that requires, the same way that what was required for Tesla, is a way to incorporate hardware and software in such a way that we can gather that data. And that, of course, is very difficult. Imagine maybe if we had something like an Apple Watch or something that is constantly monitoring the CEO of a company and gathers data about her actions, and then we can use those actions in certain machine learning type models to see how those actions then relate to the performance of the company, and then how the performance of the company eventually relates to the stock price. So this would be one approach. This is not necessarily the self-supervised reinforcement learning I was talking about, but it's one way that I think we could advance AI and advance interesting new insights into financial markets. To come back to the efficient market hypothesis, this would be perfectly consistent with the efficient market hypothesis, because what this would say is simply that we are getting new information, and with new information, according to the efficient market hypothesis, we can actually generate returns. It's the old information that doesn't generate the information which is already in the price. The self-supervised reinforcement learning would be more like, let's say the game of Go, where the financial markets are modeled as a game. The actors are investors, CEOs, CFOs. So this is a lot more complex, of course, and then you have to create reward functions for all these actors, and then from there you have a self-learning model where one of the actors, which is actually the player, which is, let's say, the hedge fund manager, then they act and they generate returns. This, to me, is a little bit further away, not because it's hard to develop the models and the reward functions and all that. That's hard enough. It's also, of course, much more difficult to have a sort of an abstract representation of the world of business and the world of financial markets in such a way that we can actually model it as a game. So this would take some time, but again, if anybody's working on this, PhDs, any conferences, please give me a shout. I am incredibly interested in this kind of work. So what would an AI do today? Let me give you a few examples. Maybe this illustrates also what I mean. Let's say, for example, you look at the latest advertisements of LVMH. I'm just using them, sort of Louis Vuitton. You could use L'Oreal, you could use Coca-Cola, but Louis Vuitton to me seems like a pretty good company when it comes to that. This is something we at Orange Capital learned. So we believe that this is new information, it's kind of new ideas. And we look at those ads, and those ads have a certain impact on the zeitgeist, or they are a good indicator for the zeitgeist of where we stand. And they're a leading indicator. So maybe 3-6 months from now, things might happen. And I'm just saying that AI that I'm talking about could be much smarter than even us, and figure out a way to use that kind of information to then make successful trading strategies. Another thing that we are working on here at Orange Capital Partners is the theory of disruption, which we have stated several times in this podcast, starts with the cost of iteration and the cost of error correction, and the lower the cost of iteration, the faster the error correction, the lower the cost of error correction, the faster innovation works, the faster you can then generate wealth as a company and therefore as a stock. So I think this AI, again, will be looking at, let's say, companies or situations, startups that have found a way to iterate faster, that have also a culture of iteration and error correction, and then again would have a certain trading strategy also that could maybe anticipate, if let's say we're looking at Tesla 20 years ago, okay, this company is incredibly good at error correction, they will be able to disrupt the car market, so let's buy Tesla short the car industry. Those kinds of trades are much more possible if you have a certain AI which just comes up with new information. So to summarize, again, revisiting the efficient market hypothesis, a incredibly valuable tool for us at Orange Capital Partners. The same way I think it should be valuable for anybody. Anybody who's interested in going into the hedge fund business should be looking at the efficient market hypothesis. Try to understand it. Try to embrace the framework, and then go from there. Don't take it as a doctrine. God forbid, don't say, oh, well, this just says I'm useless as an analyst. No, it actually says you have a lot of value added as an analyst. The only thing is, what the efficient market hypothesis says is your job's much harder than you think, because you have to come up with new information which is not reflected in the value of assets. And that is, in my view, the absolute name of the game in any kind of return-seeking hedge fund business. Find information that is not reflected in the value of assets. Of course, it has to be in a legal way. I'm not talking about inside information here. I'm talking about new information. New information can be found most elegantly with new theories that then enable the observation of new data points, which then lead to higher returns. Thank you.